Many thanks for joining. We'll be starting in about 5 minutes while we let people join. Thank you very much. We're just going to give one more minute and then we'll get started. We will be having a Q&A session at the end of the talk where you can ask any questions. Feel free to put them in. You should be able to upvote as well any that are of particular interest to you. And we will be trying to do some polls as we go along with the session to have some user engagement. We're just waiting one more minute and then we'll get started. Good afternoon, everybody. It's a pleasure hosting you on MAGNiTT's second webinar. It was amazing to get all your positive feedback on our last webinar, which was on 5 tips to fundraising in the MENA region. Today's topic is one that I find particularly fascinating. Since starting MAGNiTT, we've seen a continued acceleration in the region of funding, but at the same time, more merger stories, acquisitions, and exits. To put things into context, in 2019 to date, we've already seen 14 exits take place in the region, which is more than 4 compared to the same period in 2018. Not only that, but we've already seen 80% of the total number of exits that took place in 2018. And we predict this year to be a record year. So today I want to delve into the phenomena of exits and highlight 5 reasons why I personally think MENA is currently hot for exits. To give you an overview of what we're going to discuss, we'll start off by understanding what is an exit. What do we define as a startup exit? And then why is the region so obsessed with IPOs, and why haven't we seen these take place? What is the exit landscape that we see across the region currently? And then I will share my 5 reasons why I think the region is currently quite ripe for exits. To start with, what exactly is an exit? Well, in the US, there's been a continued phenomenon of IPOs of large tech companies. In fact, there's been 79 initial public offerings in the United States in 2019 so far, including large corporates such as Uber, Lyft, Slack, Pinterest, amongst many others. And an IPO by its name is an initial public offering, effectively taking a private company public. Currently in the region, we haven't seen a startup list on a MENA exchange or a global exchange, except for perhaps Network International, which was a company in the UAE that's grown and recently listed on the London Stock Exchange. Jumia, interestingly, was the first startup in the e-commerce space from Africa, which was listed on an exchange. And while there were plenty of rumors that Careem was to become the first startup in the MENA region, that didn't come to fruition and end up being an acquisition, which, when we look at it, is the second type of exit. Usually when a larger entity acquires the majority stake of a startup, incorporating it into a bigger company. Now, Careem was the largest and most recent example of an acquisition. And these acquisitions can come both regionally, where a company in the region acquires a smaller player in the same space, or international players coming in and acquiring regional startups, which we'll come on to discuss. Another form is where you see acqui-hires, also under the acquisition space, where teams are brought out for an exchange of equity and at times some cash. The final type is a merger. It's not quite an acquisition, but it's a merger of equals, where you usually see a larger entity being created through synergies of the 2 companies being brought together. And usually that can be to create a stronger force for the customer, to be in a better position for fundraising, or ultimately, if they're looking to fund IPO, have a larger entity as well. Now, I've been very fortunate to attend many conferences, speak to many of investors and family offices. And what's quite interesting is that there's been quite an obsession with the idea of exits, but not only exits, IPOs. I think that the region is not quite in a position to see startups IPO yet, but at the same time, it's interesting to understand why. Well, an IPO effectively in the US has come to being the stamp of approval of success. It's the holy grail for founders that want to be able to go to the exchange and say that they've listed, and for investors to see a payoff. These are the biggest magnitudes that you can have in terms of an exit. But why would a company IPO? Startups and usually large corporates, you go to IPO when they want to access a large amount of liquid capital that they are unable to get from the private markets. Many startups, unfortunately, just don't necessarily meet the requirements to listing, to being on an exchange. So the question is, who can IPO? Effectively, there is a minimum level of profitability, cash flow, market capitalization over a period of time, which is necessary to be listed on a stock exchange, whether that be London, New York, or Dubai. And exchanges may lower their requirements if you can see increasing growth in revenue or certain assets. But usually these are large, profitable corporations and traditional businesses where they're looking for additional cash to grow considerably. Many startups just don't meet these requirements. And when we look at what these requirements are, we've taken just as an example the New York Stock Exchange. Pre-tax profit of $2 million per year for the last 3 years, a global market cap of $500 million, which very few MENA-based startups have, revenue of over $100 million over at least 3 years, and cash flow of $25 million for the last 3 years. Not only that, but you see that it's extremely costly to go through an IPO exercise. You need to have a legal due diligence, financial representation, a marketing offering that makes you go on a roadshow to understand how to meet and pitch to investors, and legal guidance, all of which is extremely costly, with no guarantee of being able to put yourself on the IPO. After listing, you also see that there are many regulatory requirements, audit requirements to shareholders, as well as full transparency on the business growth of the company, which for startups that continue to pivot and change can be somewhat challenging to be held accountable to. And finally, where do you list? In the region, we haven't seen that many on the regional exchange, well, we haven't seen any exchanges, but ultimately you have London, New York, or regional exchanges, and local exchanges may have more stringent requirements than international ones, where they also provide trust on being able to list on a foreign exchange, which might provide you access to a larger capital pool of investors. Now, that's the IPO space. And like I mentioned, we haven't seen so many of these. But let's look at what is the exit landscape for the time being across MENA. How does it look? Well, as I mentioned, we've begun to see an acceleration in the number of exits, and we predict this to continue to grow with what will be a record this year. If you go back to 2012 or prior, there were large exits that took place at the time, such as AME's acquisition by EMAP. You had Maktub being acquired by Yahoo. And as that's continued to grow, and you've seen bigger names such as Zawiya, Dubizzle, Talabat, Souk, and Amazon. And like you can see here, you're already at 80% of 2018's figure for the number of exits that have taken place. But what's also interesting is when you start looking at the size of these deals. When you go back to, let's take, for example, Zawiya in 2010 that was acquired by Thomson Reuters, the size, or at least the disclosed size of the deals, and let's be clear, many deals are often undisclosed, and we can only base this analysis on those that are disclosed, was at around 40 million. In 2015, what was heralded as a massive success story in the exit space was Talabat, which was purchased for 170 million. In 2017, Souk was acquired ultimately by Amazon, including the payment gateway system, paid for 580 million. A note on that, which is quite interesting, was that at the time, many heralded the Souk company as being a unicorn being valued at over $1 billion. Something that we all learn is that actually your value is only the amount that somebody is ready to pay for you, not the notional amount that you may envisage your company is worth based on a previous funding round, although that is a good benchmark or indicator. But in Souk's case, ultimately it wasn't a unicorn, as it was only purchased for less than 600 million. And then recently we have seen the first unicorn that comes out of the region, which was Careem, purchased by Uber as they went into their IPO, and that's something that's extremely beneficial. I do want to take the opportunity now, after you see that there's an acceleration in the actual size and number of exits that are taking place, to see why exits are beneficial for the overall ecosystem. If you take the Careem's acquisition as an example, there's multiple stakeholders that benefit from any given exit. And here we've only highlighted 5, but there's many more. Let's start with the founders. It's interesting when you start looking at some of the comments that are made post-exit, that some people highlighted why didn't they continue to expand and grow, and why did they cop out and sell? I think some people forget how difficult it can be being a founder, and that when you get such large acquisitions, options or opportunities, that it's a massive financial payoff for the original founders. But the external benefit that comes from that is the network effect of that exit. The founders then go on to be interested in supporting the ecosystem and providing feedback to the ecosystem at large, whether it's government support, mentorship, or investing themselves. The second is the investors. Ultimately, investors invest in startups to have exponential returns. And those returns are extremely healthy for the fund, but not only the fund, those that are able to go on and fundraise have a success story under their belt. So it's great to have success stories in that fund. The third people are the LPs in the actual fund themselves. In the region, the VC and startup space is still relatively new. And therefore, to be able to see an acceleration and growth of investments in funds, you want to see more LPs investing in those funds. The success stories of the return of investments makes them interested in people further investing as an asset class. And that's what we've seen now. Many of the people that may have been on the fence to invest in Careem or the original funds, such as the Bico Capitals, MEVPs, and Wandas, now are more interested because they can see a potential return. The fourth group of people are the employees. Ultimately, whether it was them having a shareholder stake by being early investors or working for such institutions, it becomes much easier for them to fundraise if they were to go on and build companies because they work for a successful startup and have the experience doing that. That's something as a stamp of approval that can act as an incentive. And finally, the governments. As we're aware, governments across the whole of the region are interested in promoting entrepreneurship and innovation. Having success stories that can emanate from the region creates international awareness that can be extremely beneficial to put the MENA landscape on the startup ecosystem map as somewhere where you can actually see large success stories, inspiring entrepreneurs, investors, corporates, and people across the landscape. I now want to just go on to why I currently think that we're seeing this increased activity of M&A and exits in the region. To start off with, this chart basically maps out every startup that has received investment since 2009 to date. And what you see at the bottom is the year that they were founded, and the colors effectively highlight the stage that they're at. We did a report 2 years ago that highlighted to get to Series B and Series C, it ultimately takes about 4 to 5 years to get to that sweet spot of maturity, where you're effectively potentially up for acquisition or growth. And so what you're seeing now with the sweet spot of later stage startups and Series B startups around the 2018 and 2014 mark, many of those companies are becoming very interesting for acquisition by international players. But you're also seeing the growth of many early stage startups, which comes on to my second point. A second way to see this M&A activity is that when you're seeing many players, specifically in industries that are overpopulated, such as e-commerce, you see transport and logistics, potentially fintech, that when you see similar companies in geographies across the region competing, larger such players may start to look to their competitors to acquire them, to have a larger footprint, to be able to become more interesting propositions for investment and potential exits themselves. So the second thing that we see is regional consolidation within specific industries where companies are being acquired. The third phenomenon is that we're seeing an international acquirer acceleration. More companies are becoming interesting for international startups, like your Ubers and Amazons, that are seeing the Middle East, where historically may have been challenging to enter the market, may have not seen the potential of growth, may have not seen the opportunities of scale, are seeing founders overcome the bureaucratic hurdle and the scale hurdles and actually pay a premium to acquire them rather than doing it themselves. That also brings on an interesting potential of international investors. And this is two ways that you see this. As you see big success stories like Kareem and Souk going into the international press, such as Bloomberg, TechCrunch, and the FT, investors from across the globe begin to see the MENA region as somewhere that they should start deploying capital. And they can either do it in two ways: deploying capital directly and making investments in those startups, or the second, identifying potential synergies within their portfolio companies that they fund to make acquisitions in companies that are similar to those. So companies in China, for instance, may be given capital through their investors or through the investments that they've made to acquire similar companies to improve their footprint in the region. And that's something that's interesting for both the investor and the startup as they better understand the startups within the landscape. The final one is corporates. Corporates are beginning to understand the value of innovation and entrepreneurship and the way that they can actually support them in that space. And a good example of this, for example, is MAGNiTT. In an attempt to digitalize and create omni-channels, they have now identified startups in different kind of segments. Beam Wallet was one for digital payments, and then Wadi for delivery and e-commerce as options for applications that they can acquire. So just to reiterate, there's 5 different reasons I think that we're currently seeing a flurry of activity. Number one, a maturing market where you're seeing startups actually getting to a scale that become interesting for acquisition. Number two, regional consolidation in extremely busy markets where you're seeing slightly larger players within the ecosystem acquiring smaller companies within them to get a larger footprint. Number three, international players becoming interested in startups in this space that want to build their footprint in the MENA region as they may go on to grow. And if you take Uber as a perfect example, they were able to further grow their footprint in the Middle East, coming up to their own IPO by acquiring Careem. And actually, when you look at it, instead of competing with Careem, we're able to further strengthen their position for their IPO. Investors becoming interested directly or through their portfolio companies or corporates. Finally, I want to see how MAGNiTT can support you, whether you're a startup or an investor. Identify startups that are interesting. The first thing I would like to highlight is that we've recently acknowledged that there's an increase in the number of acquisitions that are taking place. Using the directory, you can now filter using the acquisition filter to identify companies that have already been acquired to see what type of activity is taking place. The second thing is to use the directory on the MAGNiTT page to look at competitors. You can either find competitors that may be interesting for you to have discussion with or for potential investment in this space. And then when you find them, you can connect with them directly through the platform and message them using their profiles on MAGNiTT. The last thing I wanted to highlight is that it's great to see this engagement and number of people interested in the MAGNiTT platform and what it is that we're sharing in terms of content. Number one, I would love to see it. If you have any feedback, feel free to share this and include it as part of this on the platform. The second thing is I would love to see more subscribers of the platform, and as such, we're offering a 30% discount for anybody that would like to get an annual plan on MAGNiTT. Karam from our team will be reaching out to you, and this tool really allows you to identify competitors. It allows you to identify potential investors if you're a startup, but it also allows you to identify potential synergies that you can find on the platform and better understand what's taking place in this space. So for anybody that's interested in getting a subscription, there's a 30% discount from this webinar that you'll be able to avail of before Thursday, the 4th of July, and Karan will be messaging you for more details. Now that we've concluded the presentation, I would love to see if there's any Q&A activity that you would like to answer. I've enabled this, and please let me know if you have any questions. You can go to the Q&A section of the webinar and share any questions that you would like to answer. One of the things that somebody has just asked as a question is, which industries are seeing the most traction in terms of exits? Interestingly, the ones that are most funded are usually the ones that see the most activity. So when we look at the data that MAGNiTT has been sharing, historically in the last couple of years, e-commerce, transport and logistics have been the most populated industries by number of startups, but also investment deals. And as you start seeing the noon growth and the noon and soup competition, it becomes easier to start acquiring startups within those domains as an example of an industry that is interesting for acquisition. The second thing is that fintech now, fintech is an industry that has proven to be quite interesting. So we may see more consolidation as regulators encourage more startups within that domain to start connecting and investing in that space. The third is to try and understand the international landscape. When you start looking at international acquirers, they are looking for startups that have managed to acquire mass scale across the region. So when you start looking at what are the largest startups, now I'm not saying that these companies are necessarily the companies that will be acquired, but companies like AWOC, Mawdu', Anghami have been touted as companies, Fetcher, for instance, that have large scale across the region. They become very interesting in terms of potential acquirers in this space. Have we seen any fintech exits in the Middle East to date? I believe we have seen some partial investments in the fintech space. There has been TPay in Egypt, which was the first dragon exit that for the A15 investment fund that was done. And so this was interesting. When you discuss a dragon exit is that the amount of the exit covers the initial size of the fund for the investor. So if you think that an investment fund, take an example, is $20 million, and one individual payoff from an exit covers that fund, it means that every single additional exit in that fund acts as an additional return on investment. And that's why dragon exits are very beneficial, because it means that all the additional startups are additional and you don't need to cover the original amount allocated in the fund. And it's a good question that I will share the answer to if there are other fintech examples separately. But to my mind, that is a good example of a fintech company. There is a question by Tarek that says, how far away do you think we are from having a regional startup IPO? As I kind of mentioned earlier, to have a regional startup IPO, you need to have a company that is at mass scale, that has revenue that can justify being on a public domain. I think that's something that's important to try and understand, is that a public IPO means that you're putting the faith in the public to make that investment, and that your accountability is now going to be in that public domain with regards to regulatory reporting, strategy, and growth. Even in the US, many of the startups that are being listed are not actually profitable. Many of them have large revenues and large user growths, but many of them are not profitable. And that becomes a challenge for many of the regulators, because historically, large corporates have revenue and audited accounts for 3 years that are cash flow positive, that become interesting to be able to put their faith in the public domain. That being said, mass scale is another issue. Here in the region, there are not that many startups that have mass geographical scale or have gone beyond the region in terms of growth that becomes interesting for startup investment. There has been, in all of the government meetings that I've had, discussions to see how you can create a secondary market for startups that can create some liquidity without needing to be a full IPO. Again, it's a regulatory issue. Where are you going to list, and who's going to take the responsibility for that? So the question of when will we see a regional IPO, I think that it's going to take, when you go back to the maturity of the ecosystem, as I highlighted here, some of these startups that are later stage that can have breakaway beyond the MENA region, which, for instance, Kareem was able to do in Pakistan and one or two other geographies like Turkey, but not at mass scale, I think we're going to see outside of the region exponential growth and potentially multiple product lines rather than focusing on single product lines or a few product lines so that you can justify the revenue to be able to go to IPO. There's a question here, what about crowdfunding? I mean, that's unrelated to this subject specifically, but crowdfunding is something that even MAGNiTT has explored. That when you look at the regulatory landscape here, is quite a challenging one to get into. The issue with crowdfunding is when you look at the US, many of the companies that are doing this are regulated or at least incorporated in Delaware. Delaware is a cost-effective environment where startups are able to register and put themselves. Here, when you look at the regulatory environment, many of the companies, when it comes to investments, are not actually located in the UAE, Saudi, Jordan, etc., but create BVI entities or third-party entities, such as ADGM. But the cost associated with that, without actually receiving the investment, is quite high. And when it is, you need all of the investors to be able to be comfortable to invest in a specific jurisdiction. So I don't think that crowdfunding is impossible. You already have some examples of that. But as somebody has recently just mentioned, Musab says, recently Saudi has regulated crowdfunding as a potential option. And that's true. But when you look at international investors, are they comfortable investing in a Saudi entity is not mass scale and something that is yet to be seen. It'll probably be for very early stage investment rather than later stage investment as a space. Do you think social media companies would be Mushtaba asked, do you think social media companies would be of interest for investors and exits? Keeping in mind that social media companies aren't profitable early enough usually. Well, again, it comes down to numbers. Interestingly, media companies are interesting for exits, not IPOs, but exits, because they are being highly adopted. I'm not saying that this is a company that is going to exit, but when you look at Mawdu' and what they're doing in this space, they've managed to dominate a massive market of Arabic content that becomes very interesting for investment. Currently, they've done a recent round of investment and they continue to do rounds of investments. And that's something that becomes quite interesting because for exits, if they can continue to get investment, they put themselves in a much better, stronger position for potential exiting. So I don't think that the question is social media companies specifically, but all companies need to look for exponential growth with strong revenue projections to be interesting for an acquisition, unless it's for the purposes of user growth for geographical expansion. You showed a chart that details exit timelines showing a 4 to 5 year point as the sweet spot. What industries have you covered in this chart, and can we use MAGNiTT to view data to create a similar chart but split up by industry? So to the first question, this is all investments that have taken place between 2009 and 2018. I think on MAGNiTT now we have 1,600 plus investments that we have recorded across the region. And so this would chart all of them. Can you use MAGNiTT? There are an analytics tool on MAGNiTT, not to create this chart specifically, but an analytics tool which becomes part of the pro subscription, where you can manipulate data and information on MAGNiTT based on industry, geography, stage, and year, that you can create and export charts using the tool on MAGNiTT. That includes funding, top 10 investors, top startups, as well as the stage of all of the startups. And if you would like to have more information, email karam@magnitt.com and we can provide a demo on getting that kind of information. There's a question which says, but what about informal private marketplaces for secondaries? Regulation is not going to stop a transaction between two parties. They're being done all the time. Indeed, correct. There are such transactions being done, and often as you get into later stage funding, either the investments are done directly by the later stage investors that want to clean up the cap table, and that's not something that's completely unknown, that they want to take out the earlier stage investors, especially angels, because that's something that becomes a challenge for later stage investors when they go for latest rounds of investments. But indeed, there is nothing that will stop people from being acquired or cleaning up the cap table. The question becomes how to make that a regulated industry at mass scale. And while you point out examples like SharesPost and EquityZen, it's just not at mass scale for the time being, and not something that is very liquid because of the regulation and legal costs around that. But of course, it doesn't mean that that isn't something that isn't done already. Our success stories mainly from the UAE, Kuwait, Egypt, i.e. potential unicorns. Look, I think that we're beginning to see dynamics change across the whole of the region. Thank you, Yahya, for the question. What's fascinating is that the competition across geographies is creating lower barriers to entry for startups to set up, but also to scale. Sagia, for instance, is creating a huge amount of initiatives to encourage startups to be able to scale into Saudi Arabia. And therefore, where the startup is located is almost immaterial. I know that there is a geographical focus on that because people, when you go on to the governments as a stakeholder, are keen to see startups housed and located within a specific jurisdiction and become a success out of that jurisdiction. But you just need to look at Careem as an example. For Careem to be successful, they needed to be in multiple geographies. They needed to scale into Saudi Arabia. They had to have a footprint in Egypt. They needed to have a footprint in Jordan, Lebanon, in all markets, although some of them were loss-making, to become interesting for acquisition. So the question is not where they originally started from, it's what's their geographical footprint and what can governments do across the region. And trust me, I advocate this all the time, to make it easier and more cost-effective for startups to scale into additional geographies, to make them more interesting for exits and acquisition and growth as a startup. So it's not so much whether it's the UAE, Kuwait, Egypt. Yes, Kuwait has become a very interesting ecosystem for food tech startups. It's amazing how many food tech startups, not just Talabat, but examples such as Carriage or other companies in that space. But as potential unicorns, these companies need to be spread across the whole of the region, if not break out outside of the region, which was the point I made earlier. Careem was able to scale into Turkey. It was able to scale into a few African countries. It was able to scale into Pakistan, not just the MENA region, to become a unicorn. At a unicorn, you need revenue valuations that are in the 300, 400 million on an annual basis to be able to be valued at such an amount. That could be done only in the MENA region, but is more likely to be done when startups are able to scale outside of the region. There's a question of what do you think about content creation in the MENA region? When you look at the amount of digitalization, U-Turn is an extremely interesting example, which is an online entertainment network which has Arabic video content, originally a Saudi-based company. When you look at the numbers of digital penetration and smartphone usage, it's extremely high here in the region. Even Mawdu', which I mentioned earlier as an example, as a company that is looking in the Arabic digital space. I think this is something that is still being developed and has huge opportunity for growth. I wouldn't be surprised if we start seeing larger investments in those type of companies in the next couple of years, and if not, an exit in that space as you see international players. But when we look back, EMPG, that was the acquirer of AME Info, is one example that received a lot of funding. And Stars Plays Arabia is something, when you look at the Netflix space, it could be extremely interesting. These companies, when you look at Netflix's valuation, it's not only content dissemination, but it's also content creation. And when you see what Angarami is doing specifically in the content creation space to go above and beyond just streaming of music, those become very interesting companies for international acquisitions and potentially getting to a unicorn valuation. So I wouldn't be surprised if those people are interesting companies in that space. Salman is asking a question. Careem exit made a lot of employees rich, but is the region mature enough in terms of providing and honoring the ESOP and employee shares? Very good question. It's difficult to see the regulation around this, but when you get to those type of companies, like I said earlier, they're not actually regulated necessarily here in the region, to the extent whereby many of the share and ESOP plans are actually done in offshore jurisdictions. So they would have probably done in a BVI entity, if not in a Delaware company, where the honoring of those ESOP plans would be done in international level. And again, the honoring of the ESOP plans is part of, number one, the risk, but also the success of a startup. I think what we've had in discussions with many different investors is that people are saying that it's important to have ESOP plans in place to encourage and foster innovation, because you want to have buy-in by the early employees. They may not be getting paid as much as they should be at market rate, often because the startups can't afford to do them. But having an ESOP plan is extremely important. Sharif Al-Badawi always says, whenever you go to a Series A investment, you need to have a proportion of 15 to 20% of the employee share plan in ESOP so that people can be incentivized. And to be able to do that, you need to actually have the legal paperwork in place and actually structure it accordingly. So I think it's very important that those are being honored. And I don't think that from a regulatory perspective, it's an issue if the structuring of the company is done through an offshore entity. The call is for half an hour. I'm happy to answer maybe one or two more questions if you have any. Otherwise, I'll thank you. I'll just wait a couple of seconds to see if there's any new questions that you would like to share. Ivo, thank you, and I thank you for participating as well. In that case, I would like to thank all of you for participating. I would love to have any feedback that you have. I think that we'll be doing another webinar in July that may be on the back of the results of our half-year report, which we'll be sharing closer to the time. We look to launch that in the next couple of weeks. Again, please share any feedback. Currently reach out to any of you that may be interested in in getting a subscription with a discount, which will be available until the 4th of July. And please let me know if you have any feedback or questions, and we will reach out to you shortly. Thank you very much.